Don't try to own Bitcoin. Try to get an exposure to it. The real answer to the CFO is not to tell him, convince him the superiority of Bitcoin. It's to tell him why is it that you don't own it, in fact.
Because of the scarcity, it's a better form of gold, effectively. You know, the probability in my mind of becoming this new asset class that, you know, reaches the kind of size that Hal Finney put out there as the addressable market the first or second day that the Bitcoin network started, or this 200 trillion mark.
It's not Bitcoin which is gold in backer. I think that gold is Bitcoin in worse.
For someone like a BlackRock or Fidelity to add a new market, let alone a new asset, can take anything between 3 and 6 months, right? And so, you know, it's very hard to get an asset that trades 24/7.
Let's welcome to this amazing crowd on stage.
All right. Thomas will be joining us in a few minutes, just running a few minutes late, but we'll go ahead and get started. I thought we'd kick off with Adam and Yves, start with the two of you. From a protocol and monetary design perspective, what makes Bitcoin uniquely well suited to become a corporate reserve asset?
So I would say it's security first, in terms of IT security, and very conservative, very dependable, and, you know, in my opinion, the only investment-grade crypto asset, let's say.
Yves, what would you add to that?
I think that Bitcoin, in fact, is the first technological solution proposed to the problem of storage of value. Yeah. In fact, mankind, had many problems. And usually mankind deals with those problems in two steps. The first step is intuitive, and then it's technology. One of the oldest problems of humanity was inflections. We dealt with inflections in the beginning in an intuitive fashion until we discovered the technological solution.
Yeah.
And in fact, if you look at one of the oldest problems of humanity, which is storage of value, we have always dealt with it intuitively. Shells, brass, silver, gold, paper signed by the king or paper signed by the government. Until, for the first time in the history of humanity, we have a proposal of a technological solution. Mm-hmm. It's really an engineer who built it. And if any engineer, you ask any engineer, how would you store value? He would come up with 5 words. Digital, unforgeable, can be exchanged peer-to-peer, carved in stone, decentralized governance, and limited quantity. Yep. And if you use those 5 characteristics, you have described precisely what Bitcoin is. And this is what, in my mind, makes it that Bitcoin is the way to store value. Yeah. Scientifically speaking.
Yep. No, that makes great sense. So let's build on that a little bit, Yves. So TOBAM approaches Bitcoin from a portfolio construction lens. So how should a corporate treasury be thinking about the optimal allocation size of Bitcoin into the treasury?
Okay. So what is a Bitcoin treasury company? The Bitcoin treasury company is applying a model that was created in 1694. In 1694, a group of businessmen met in London and decided to create a company that would raise capital in order to buy gold. And they decided to call this company the Bank of England. In 1800, France did the same and created Banque de France. And those two companies became the most prosperous companies in the world until they were, unfortunately, nationalized in 1945 and 1946. So a treasury company is a very, very specific kind of company. It's a company that has a balance sheet, composed of assets and liability. And what is very specific to treasury companies, it is that they want to have the most boring asset side of the balance sheet that you can imagine. There is nothing more boring than owning a cave full of gold. Mm-hmm. There is nothing more boring than owning Bitcoins. What is inventive in the treasury company is on the liability side. Mm-hmm. You are going to deploy engineering, financial engineering, in order to make it available for people to buy securities that will allow you to grow your reserves. Mm-hmm. So the magic, what is really specific with those reserve institutions that we call treasury companies, It is that the inventivity is completely specific to the liability side of the company, and you don't want to be inventive on the asset side.
Yeah. Yep. Oleg, when you think about second layer technologies like Lightning or Liquid or other side chains, do you think they're going to play a meaningful role for corporate treasury operations, or will it be primarily a base layer Bitcoin story?
When you think about Bitcoin, what is unique about it is it is both an asset and the technology that enables productive use of this asset. Lightning and Liquid are examples of this technology that can help store Bitcoin in a secure way and also send and receive Bitcoin and make Bitcoin a productive asset. So when we're thinking about Bitcoin as an asset to accumulate in a treasury, and when you think about passive accumulation, then probably on-chain is like the best way to keep it, given that it's also using the best and the right fit-for-purpose technology primitives, such as like multi-sig and collaborative custody. But when you think about extracting productive use of Bitcoin, then this is where all the additional technologies come to play. Liquid network and Lightning network and like other technologies that that can be adopted by an enterprise with Bitcoin in its treasury to actually uncover the productive use of Bitcoin.
Yeah. Yeah, I think that's going to be a huge opportunity there to build upon. Adam, so from where do you see the biggest gaps today in the infrastructure for large-scale corporate adoption of a Bitcoin treasury? Is that around custody? Is it around scalability? Is it around settlement? Like, what do you think where's the gap that's keeping it from taking off?
I mean, I think there is room to improve the custody technology in terms of the technology that a custodian would use or that a company could use to hold their own Bitcoin with their own personnel managing it. So, there are different wallet technologies that have basically been scaled up with HSMs. Of course, generally the most robust security is an air gap, i.e. something that's offline. So curiously, the retail hardware wallets are actually, very, very good. And, I think obviously some of the custodians are using that same kind of model, but with different hardware, with HSM hardware instead of consumer hardware. I think multi-sig forms part of it, and ultimately in the longer term, the governance discussion with Bitcoin or more scripts capability to be able to do sort of time lock storage, which is it's very interesting that Bitcoin, even though it's electronic cash, is very physically rooted in terms of the mining is a physical thing, so it's physically scarce even though it's digital. And then the storage is also in some ways low tech, right? Because when you're talking about a time lock vault, it's kind of like the system that evolved with banks so that the manager couldn't open the vault except during the daytime, right? So it improves security. And you can apply that same kind of reasoning to Bitcoin. You've got the physical backup devices, the steel backup devices like crypto steels. And with with a little bit more covenant technology than Bitcoin currently has, you can implement a time lock mechanism for the withdrawal from custody, which I think enhances security. Now, ideally, that needs to be on a base layer, and I think a lot of things could be done on a layer 2, but cold storage is one of the things you really want to do on layer 1 because that's the right place to optimize for really secure long-term storage.
Yves, when you think of Bitcoin, is it best understood as digital gold, a risk asset, or something entirely differently when you're thinking about putting it inside a treasury portfolio?
In a limited number of words, I would say that Bitcoin is real gross gold. So it's like gold, except that it is auditable. It's like gold, except that it's limited in quantity. And in addition to gold, it has this property of being a growth asset. So in fact, I would say that it's not Bitcoin which is gold in better. I think that gold is Bitcoin worse. In fact, I think that across the history of those intuitions I was talking about, we have tried to invent Bitcoin. And I think that Bitcoin is probably the final solution to the idea of storage of value. And it has some characteristics that are a little bit adverse to very large ownership. Typically, the largest investors in the world have liabilities. A pension fund has liability. And the Bitcoin, via its volatility, because of its volatility, etc., could not be fit exactly, the portfolio. And I think what we are going to create in the industry is to transform the question from why don't you own Bitcoin to why are you not exposed to Bitcoin? And really the answer, which will make it for the Bitcoin to be extremely largely used, is via indirect ownership. Typically, if you buy a preferred, you are exposed to Bitcoin in a very indirect fashion. And it is the engineering of Michael Saylor and the engineering of people that are alike that are going to make the very specific properties of Bitcoin of help to a very, very large number of people.
So, Adam, you've been out there in the public space saying that you think that all companies will eventually have Bitcoin on the balance sheet. Can you talk a little bit about that and what does that look like and how does that get started?
Yeah, I mean, as Yves said, Bitcoin is also a growth asset in the sense that it's early in the adoption cycle, and in sort of any technology curve, there's some kind of S curve or something like that as it goes through different phases of adoption. Now, we don't know exactly what Bitcoin's full adoption looks like, but I think generally people would have to view that as growth assets or growth stocks reach maturity, the volatility goes down, and of course, everybody that wants Bitcoin exposure has Bitcoin exposure at that point. The characteristics are changing as it gets closer to it, and so I think because of the scarcity, because it's a better form of gold effectively, that it stands, the probability in my mind of becoming this new asset class that reaches the kind of size that Hal Finney put out there as the addressable market on the first or second day that the Bitcoin network started, of this 200 trillion mark, which is, I think he was just looking at addressable market of bonds and money substitutes and things like that. So it's probably more now due to inflation. But, at that point, buying that becomes a way to preserve spending power, where in absence of that, everybody has to basically be a relatively successful trader to even preserve their spending power against real inflation. And of course, it's for any investor, you're looking at what is the inflation as your hurdle rate, because if you fail to beat inflation, you're actually losing your spending power. And it turns out that it's often ambiguous what the real inflation rate is, because governments have an incentive, monetary policy committees have an incentive to, to tune inflation to make things look better than they are. And certainly people can feel the inflation of what they experience personally, loosely, right? So I think that Bitcoin, ultimately can become this new asset class, a new alternative. So if people they don't have to be speculative investors to preserve their spending power. They can buy and hold Bitcoin long term. Now, it wouldn't necessarily have a big growth curve ahead of it at that point, but it would also be less volatile, and so more suited to that kind of function. And then, of course, you have structured products on top of that, because for the short term, it's more volatile, but you can kind of transform it in the way that Michael Saylor has explored with, the different preferred shares that he's gone through with, Strike and Stride and Strife, and finally Stretch, which has, captured much more market imagination than the other ones. And so you can see that's a form of capital transformation, or giving people a Bitcoin-related yield, but without the volatility. And so they're, in the longer term, the asset itself may end up behaving like that almost natively, or with perhaps less volatility than now anyway.
So Yves, I'm sure there's some CFOs out there in the audience. Like, if they wanted to dip a toe into putting some Bitcoin on the balance sheet in the Treasury, is that in your mind like just get off 0 and do 1%? Is it try to do 5? Like, what would you like suggest for someone that maybe is a TradFi person in the audience that wants to, they're crypto curious, or the Bitcoin curious, and that's why they're here? Where do they start?
The right way to start, in my mind, is a common answer to almost any kind of risk factor. Don't try to own Bitcoin. Try to get an exposure to it.
Yeah.
Okay. And you will find an instrument that exactly fits your need, which engine, in fact, is Bitcoin. It's like, in fact, at the end of the day, if you were bullish on the internet in 1997, it was wrong to own the infrastructure. If you're bullish on the fact that building railways between the East Coast and the West Coast is going to create value, you should not buy the railway, you should buy land in California. So in fact, at the end of the day, what you really want to own is something that will take advantage of the properties of the Bitcoin. You don't need to own directly Bitcoin. If your liability spectrum, if your utility function makes it that Bitcoin is compatible with your objective, go ahead, buy Bitcoin. But I think most often it is the wrong answer. Most often you will want to invest in something that is going to take advantage of the qualities of the Bitcoin.
So it could be adding a smidge of stretch or a smidge of SATA, or something like that.
Volatility, or buying whatever you want.
Yeah.
So our job is really to adapt the engine to the needs. And the real answer to the CFO is not to tell him, to convince him about the superiority of Bitcoin. It's to tell him why is it that you don't own it, in fact.
Yeah.
Is it because it's not a security? In that case, we're going to provide you with a security. Is it because it's too volatile? We are going to provide you with something less volatile. It is because you need yield? We are going to create something which is yield. Bitcoin is an engine.
So that tees up a nice question for Tommy. Hi, Tommy, welcome. So you're on the front lines with clients. You're talking to clients directly. And I'm sure you get questions and concerns from clients and corporate clients and high net worth clients and what have you. What are the concerns that they raise about maybe getting exposure to Bitcoin in a treasury format, or just Bitcoin exposure in general?
Okay. First of all, sorry for being late for the panel. Regardless of how many conferences I go to, I still underestimate Uber and the correlation with rain. But nice to be here. I'm representing Xapo Bank. We were founded in 2013. Initially as a Bitcoin access product, so buying and storing Bitcoin. And then we've evolved over the years to be a regulated custodian, a regulated bank. And now we're perceived as really a wealth platform. And so there's a lot of Bitcoin holders who've been with us since the start, where they want a utility on their Bitcoin from a retail lens. Why we've opened and reopened up our institutional business, to Sean's point, is first of all, we have retail that have now transferring that wealth into SPVs and family offices. And so let's just say crypto native family offices that know Xapo and trust Xapo. And so we've built an offering around that and been able to offer yield to that community. For the corporates, when I look at corporates, we've brought in a global sales team and coverage team. We kind of segment them, right? And so if you look at institutions on the left-hand side of sort of crypto adoption, so traditional asset managers, pension funds, insurance companies, realistically, for them to get into a new asset class is a huge hurdle. And Sean's very well placed to talk us through his pension experience. But so there are exceptions, but broadly, having worked in investment banks in equity markets, for someone like a BlackRock or Fidelity to add a new market, let alone a new asset, can take anything between 3 and 6 months. Right, and so it's very hard to get an asset that trades 24/7 into their portfolio risk management systems, into that sort of pipes and plumbing, and so that's where the ETF has been transformational there as an entry point for institutions, and now increasingly the DATs and the corporate treasuries, because they are listed equity and they do fit their risk profile and they do fit their PMS. And so I think DATs and corporate treasuries have a very important role to play in that institutional segment that's very sophisticated, traditional asset manager and insurance and pension. We're less relevant to that community right now. We see, we service the DATS community and the ETF community that actually sell to that segment. Where we're most relevant is miners, the DATS themselves, crypto native family offices, Web3 companies that are holding Bitcoin. But if you look at just broader institutional adoption, as I'm sure we'll come on to, sort of signals and forecasts for the future, that's something we look at very closely. What's the retail ownership of Bitcoin versus the institutional ownership? And if you look at volatility, and even post the ETF, what drives bigger institutional interest? Reduced volatility is one metric and one signal, and we'll delve into that. But yeah, hopefully to summarize, from an institutional lens, we segment institutions into sort of traditional finance, and then the various entities. And I think ETFs, and specifically more recently DATs and corporate treasuries, are actually pivotal in accelerating that institutional adoption, because they're just not ready to buy the Bitcoin native product yet. And as my colleague panelists mentioned, the optionality and the capital markets within those digital asset treasury companies is a real leverage point for an accelerator for institutional adoption.
Very interesting. Now, Oleg, you were probably one of the first guys to kind of help companies establish a Bitcoin treasury, right? I mean, you guys, when you are as a venture investment, you'll often make an investment via Bitcoin rather than fiat. Can you talk about some of the benefits for a startup of having Bitcoin treasury versus having, say, invested in fiat in the company? Like going back to some of those startups that you guys do.
So when we started as a venture capital firm in 2019, we were always encouraging startups to allocate a portion of their fundraise to Bitcoin. And the reason was very simple. So when you're an early stage startup, there is a lot of uncertainty as to how much runway you're actually going to use up until you get to the next fundraise. So like a 10-20% is almost like a margin of error. And if you time your Bitcoin allocation wisely, so you're not like really buying at the top, but buying somewhere closer to like the local bottom of the market, then you can potentially enjoy this upside of arriving closer to the end of your runway when you still have some Bitcoin in treasury, and then you could just like sell that Bitcoin with a premium and extend your runway. But at the same time, if you completely lose your Bitcoin treasury because you like lost the keys or something else, then you would only lose like this kind of like marginal error of your runway, which is of course not great, but compared to like the potential upside of extending your runway, it's what we have been always suggesting to startups to think about, so that they can have this optionality of extending their runway with Bitcoin. And it's always like also following the eat your own dog food thesis. So you really need to get your hands dirty and engage with Bitcoin if you're building the Bitcoin space.
Yeah, I've been really I bumped into a couple of startups that were did this Bitcoin treasury thing, and it's kind of amazing how much it has extended the runway for some of these companies. Like they're like, oh well, when we originally raised our round, we raised for 24 months, but because Bitcoin went on a tear, we had 36 or 40 months worth of runway, which really is an amazing benefit.
Yeah, the typical statistics in venture capital is that startups die in like the third year. But in our portfolio, most of them are like still alive, which is probably also because some of them had a Bitcoin treasury from the beginning.
Yeah. And then, Oleg, just to follow up on that, so you guys have been doing this for a long time, 2019 with Bitcoin treasuries for startups. What other innovations are you kind of watching that you think could unlock this space further for more development in that area from a venture side?
So we've been noticing more and more that Bitcoin comes closer to the capital markets and traditional finance. That's what this conversation is partially about. And we've been very curious about what kind of technologies can actually help advance Bitcoin into the enterprise and to traditional finance space. And if you think about what a traditional enterprise thinks about adoption of a new technology, so commonly they would prefer to deal with a mature technology, so the technology that has existed in the market for quite some time. Then they would also seek for technology with the lowest cost of ownership, so they don't really have to spend much on maintaining, developing, and actualizing the technology, but the technology that would give them the most benefit. At the same time, technology would be conservative enough so that they don't really have to learn like every other day what's new coming up, and would give them reasonable space for innovation so that they can like stay ahead of the game if they wanted to. But they would originally want to bet on a technology that's coming from a threat setter. So in that regard, technologies such as Liquid Network, a sidechain to Bitcoin, which shares the Bitcoin code base, has existed for quite some years and has quite some institutional-grade assets secured by the Liquid Network functionaries. So it also has an ecosystem around it. So this is kind of a type of technology that can really unlock a lot of value in the enterprise space when it comes to traditional finance, because you have all the benefits of open source code base, which is Bitcoin, which is under a lot of scrutiny for many years. Then you have an ecosystem of functionaries and members that bootstrapped the network to the level where it is right now. And then you can either build and just join the existing Liquid network, which is like very easy. You can just all the primitives are already there. There are wallets, there is tokenization platforms, there is the network. You can become a member of a network, or you become one of the functionaries. And then eventually, as we've been talking more and more with like banks and other players in traditional finance, sometimes they would prefer some kind of like more controlled environment, but they are currently at the point that they understand that private blockchains like make no sense, and at the same time maybe they were too kind of like risk averse to do everything on like the main chain. So they could use Liquid network derivative like the elements based network using the same code base as Liquid network, and spawn their own sidechain that would inherit all the properties of the Bitcoin code base, Liquid code base, but would have adaptable behavior to, say, for example, adhere to some regulatory norms or create like a consensus environment that this consortium or federation would want to have in terms of auditability, compliance, AML, KYC, on and off ramps. And this is where we believe like a lot of value can be unlocked, both for treasury companies, for TradFi, and for crypto-native companies.
Yeah, the Liquid story is pretty amazing. I joined Blockstream a couple of years back, and I think there was like about $1 billion on there. And like today, it's like $5 billion. And you know the different types of securities that are on there are just you got a whole gamut from small business loans to strategy to you name it, hash rate, stuff, whatever you want to invest in. Tommy, from the perspective of sitting at Xapo Bank, what does best in custody and treasury management actually look like?
So great question. I would take Bitcoin custody. If you look at it as a product, right, it's over commoditized. You have a lot of crypto native custodians, best in class, BitGo, Anchorage, I can't name them all, but all very solid, Kumenu. Then you have, the traditional custodians becoming involved given the interest, right? So Citi, JP, Boney, all of them, right? As the world of tokenization and digital assets. What's interesting is obviously a lot of the new players are white labeling to the crypto natives, right? And so you kind of get this big plethora of custodians. For us, we see it as over commoditized, but we see it just as a core pillar of our offering. So, we don't cover all institutionals. To my earlier point, we're more DATS focused, miner focused, crypto native, and so we position ourselves. We're obviously aggressive on price, like everyone is, but it's a low margin business. For us, we position ourselves as, look, our USP is we don't do staking. We only do Bitcoin custody. That's all we've ever done, right? And so we have more resource to look into what does quantum computing mean for us now, 1 year's time, 5 years' time, 10 years' time, right? We have billions of dollars of Bitcoin in custody. It's been there since 2013. We've got clients in 80 countries, right? And so we feel, to the point on Liquid Network, we're very keen to work with exactly platforms like that, where you're increasing the institutional adoption of Bitcoin, and then bringing a best-in-class regulated custodian who's a bit more crypto native or familiar with the crypto native.
Yeah.
So best in class, I think there's a variety of players. For us, it's about the broader offering. So custody is our main pillar. And then our higher margin business is lending. So we lend dollars against Bitcoin. We use the Bitcoin as collateral. Again, that's still a relatively small business across the street. And one I think that will explode as we see more institutionals coming into Bitcoin.
And Xapo also lends Bitcoin, right, out in the market.
Yep. So, we're trading Bitcoin, I think, now from a treasury management perspective, again, is over commoditized.
Yeah.
There's multiple trades. And I think in fact, if you look within Europe, some of them will be here today, some of the market makers have really evolved and become best in class, whether it's BTC2 or Wintermute, a lot of these sort of European-led market makers. And I think you've had that contingent that survived 2022 post-FTX have got stronger. And, Key Rock, for instance, have just done a very successful raise. And then you've had the big TradFi market makers come in and double down. So Susquehanna, Citadel, IMC all have very strong teams. And so we face the plethora of market makers, both from a lending and borrowing perspective, and also the interaction on financing.
Yeah. So every so often we get these financial crises. We get the great financial crisis. We get the pandemic. Different things come up. The taper tantrums, what have you. So Adam and Eve's, actually, it kind of is interesting. Adam and Eve's, in a stress scenario, let's say we've had a nice placid environment for a little while here, but there could be another global liquidity crunch coming. Another bout of currency instability. We got this Strait of Hormuz stuff going on. There's a lot happening out there. From your perspective, does Bitcoin strengthen the corporate balance sheet in that environment, or could it be introducing additional new risk to the balance sheet? How do you guys view it? The liquidity that you think you would be able to access in a liquidity crunch?
Yeah, I think one of the cases for adding Bitcoin to corporate treasuries in a general sense, other than the treasury companies, as an inflation hedge or as a ingredient in the pension fund or in the model portfolios. So Sean was helping one of the first public pension plan in the US to add Bitcoin to its balance sheet and put out a 1 to 3% model portfolio recommendation to the pension fund in 2019. And now, quite a few years later, BlackRock has done something very similar, 2 to 4%. So I think it's a good diversifier even for somebody because of the lower, the relative lack of correlation. And of course, it goes through swings where it's correlated and then it's not correlated. And sometimes the correlation could be upside or downside, but the fact that it's not correlated is useful. And I think the liquidity is, improving. Wasn't so long ago that one of the kind of Bitcoin brokers sold, I think it was 80,000 Bitcoin in an afternoon, for example. It moved the price a little, but not that much, and it didn't last that long. So, there are obviously gentler ways to sell 80,000 Bitcoin than do a TWAP in an afternoon. You could do some more OTC kind of things, but yeah, I think the liquidity is actually quite good these days. And Michael Saylor has said that there's been times where he's buying, was it $100 million an hour or something? Yeah. And the market absorbs that without moving the price too much as well. So it's actually one of the very few 24/7 highly liquid markets in a lot of ways. And you would assume actually that because there are different types of investors in Bitcoin now, that liquidity can improve, because one of the earlier eras of Bitcoin weaknesses is that the people that are the investor base end up over time being almost all in Bitcoin because their other investments dwindle by comparison, because Bitcoin has outperformed for, over the long term for so many years, that with these new investors coming in, they're managing a diversified portfolio. So as they get to a point where they think they're underweight Bitcoin at this price, they will sell something else to buy it. And of course, that opportunistic reallocation adds support and liquidity in the downside volatility case. So I think that this new wave of institutional investment, by which I mean the model portfolio allocation recommendations starting to come in the market, which I think is still to come in the next few years, is going to help the liquidity, the downside liquidity as well.
Yves?
Yes, in fact, what your question and what Adam Back said inspires me. It is this very famous sentence: "What doesn't kill it will reinforce it." In fact, what is very fascinating with Bitcoin, it is that it's almost a perfect asset, perfect example of how this sentence should be effective. In fact, I would dare to say that nothing can kill Bitcoin.
No.
I had many conversations, or I listened often to Adam on quantum computing. It's fascinating to see that quantum computing cannot kill Bitcoin, and it's going to reinforce Bitcoin. AI cannot kill Bitcoin, it's going to reinforce Bitcoin. The dollar, of course, cannot kill Bitcoin, it will reinforce Bitcoin. And in fact, as an investor, we need always to remember that investing is about risk-taking. Risk is good. Risk is not bad. You don't want to avoid risk. You want to take more risks.
Yeah.
You want to take risks that are not correlated to the other risk. And in fact, Bitcoin has so many specificities from the point of view of anti-fragility, of diversification, of being a diversified asset, and of being reinforced by what can't kill it. That in fact, it's really an asset which is fascinating in its role in a portfolio.
All right. We have 57 seconds left. We'll go through for lightning round. We'll start with you, Tommy, and we'll work our way this way. What's the one signal that you're watching for that tells you that adoption is about to accelerate for Bitcoin treasuries?
Very quickly, the volatility of Bitcoin continues to decrease.
Yeah.
So if we look at realized vol at the money, sort of 1 year tenure, it's now, yesterday's print was 42. Take that back, pre-ETF it was 82, and then back to 2013 we were over 100%, right, 130%. So that's really important. And what that means for people who aren't familiar with vol, it's just think of it the same way as drawdowns, right? And so price movements in 2013, 2015, it was 80, 88% drawdown. The most recent drawdown we've had since October to now is 50%. So what that's saying is the asset is less volatile, to Yves' point. So the less volatile the asset is, the more value the new entrants come through with treasury companies where we can have capital markets and a plethora of new products like Capital B's convertible and a bunch of other, Stretch from Sailor. So more products to that institutional community. But the waterfall is that if vol is down, we're going to see more institutions, and that's healthy for Bitcoin.
That's what you're watching for. Oleg, real quick.
I'm looking for the post-MicroStrategy institutional adoption when Bitcoin converges with private debt, such as mortgages and
Yves.
So I want to be kind with our host, with Matthias, with this great city of Prague. Yeah. And I think the next signal could come from Prague.
All right.
It's probably, Prague is probably the most advanced city to have a central bank buying Bitcoin seriously.
There you go. That's interesting.
I think this is going to be a game changer. So, that the governor of the central bank here in Prague has begun buying Bitcoin as an experiment. But, maybe the next very symbolic signal will come from Prague.
Adam, last word.
Yeah, I think there are a smattering, like a few areas where sovereigns have Bitcoin exposure. The Swiss National Bank, the Abu Dhabi Sovereign Wealth Fund, Bhutan doing mining, El Salvador, of course, Prague, as you said, and some states in the US, but it's still been very slow. So, we'll see how they progress, right? There's the phrase, everybody buys Bitcoin at the price they deserve, and I think we're okay with central banks buying a couple of zeros higher. But I think the thing which was overestimated and now underestimated is the model portfolios and the news flow from the last couple of years on institutional adoption, by which we mean that managed funds. So a lot of the world's money is managed professionally. Most people don't self-direct a share portfolio. And so mutual funds, pension funds, these kind of things are managing huge pots of capital. And so when they say 2 to 4%, they haven't really done much of it yet.
Yeah.
And that is because it's very bureaucratic and slow and methodical and conservative. And so I think that, adoption in size remains ahead of us largely. So I think that's, another catalyst that's to come.
Yeah. Okay, well, I'd love to thank our hosts, Matthias and Martin, and of course, the city of Prague has been amazing. So with that, we'll wrap it up, and thank you very much